Hello everyone. In this video, we are going to learn about technical analysis. Technical analysis is a means of examining and predicting the price movements in the financial markets by using historical price charts and market statistics. It is based on the idea that if a trader can identify previous market pattern, they can form a fairly accurate prediction of future price trajectories. Technical analysis is based purely on the price charts of an asset. It is solely the identification of patterns on a chart that is used to predict future movements. As you all know, the stock market investments are considered as risky investment. Therefore, before investing in stock market, an investor should analyze the market. Fundamental analysis and technical analysis helps the investor to study the market and decide the security in which they can invest their money. While fundamental analysis focuses on the asset's true value, technical analysis is purely based on the price charts. It is a process of identifying trend reversals at an early stage to formulate buying and selling strategies. Assumptions of technical analysis. Technical analysis has the following assumptions. Interactions of supply and demand determines the market value of the scrip. The market discounts everything. Any changes taking place in the economy is quickly affect the security prices. That's why it is said that the market discounts everything. Security prices always represents the hopes, fears and insider informations of the market players. These factors may cause shift in the demand and supply, changing the directions of trends. The market always moves in a trend. Trend may be increasing or decreasing except for minor deviations. The security prices always moves in a trend. It is a way or direction of security price movements that is called trend. Technical analysis believe that the past prices predict the future. It is said that history repeats itself. This is true when it comes to security market. Increase in the prices creates positive mindset which induces the investors to buy more, leading the prices higher and vice versa. We can say that studying the past prices helps the investor to identify the trend in the market. That is why technical analysis believe that past prices predict the future. These are the assumptions on the basis of which technical analysis is prepared. Dow theory. The doctrine outlined by Charles H. Dow in 1884 in the Wall Street Journal is the basis for technical analysis. He wrote a series of articles in the journal. A.J. Nelson, a close friend of Dow, formalized the Dow theory for economic forecasting. The analysts use charts of individual stocks and moving averages in the early 1920s. Later, with the advent of calculators and computers, sophisticated techniques came into vogue. Dow theory is considered as a tool of technical analysis. It is given by Charles H. Dow. This is based on the concept of trend. Here he considers three types of trend in the market. They are primary trend, secondary trend and binary trend, studying which helps an investor can decide whether to invest in that particular security or not. Hypothesis. Dow developed his theory to explain the movement of the indices of Dow Jones average. He developed it on the basis of certain hypotheses. They are as follows. No single individual or buyer can influence the market's primary trend. It means the role of individual in influencing the market trend is minor. However, an investor can affect the daily price movements by buying or selling huge quantity of scrips. He may not be able to affect the large trend, but he can affect the daily price movements. No market discounts everything. The market discounts everything. It is the second hypothesis. Any changes taking place in the market, any changes taking place in the economy, it is reflected in the security prices. Even the natural calamities such as earthquakes, plagues, or fire quickly gets discounted in the market. Everything is represented by the security prices itself. Third one, the theory is not infallible. This theory is not given to beat the market but to provide a way to understand the market better. With the help of this theory, no one can beat the market but they can understand the market easily. That is all about the hypothesis of Dow theory. Trend. Trend refers to the direction of movement. A share price can either increase, fall, or remain flat. The three directions of share price movements are referred to as rising, falling, and flat trends. The share price do not rise or fall in a straight line. Every rise or fall in price is accompanied by a counter move. If a share price is increasing, the counter move will be fall in the price and vice versa. The security prices always moves in a particular direction. It may be upward direction, downward, or flat. This type of price movement is called trend. Every time the price moves upward, there will be some counter moves and it will be small fall in the price and vice versa. Trend reversal. The rise or fall in share prices cannot go on forever. The share price movements may reverse its direction. It is called trend reversal. Before the change of direction, certain patterns in the price movements emerge. Violation of the trend lines shows the change in the direction of trend. Here, violation of the trend line means the penetration of the trend line by the script's price. Trend does not move in a particular direction always. Here, the opposite movement of the price from the trend is called trend reversal. If the security prices are going up, at certain point of time it start to show a falling trend. It is called trend reversal and vice versa. This graph shows the trend lines. There are three trends, that is rising trend, flat trend and falling trend. The theory. The Dow theory sees a trend as a primary, intermediate and short term. The primary trend may be a broad upward and downward movement that may last for a year or two. The intermediate trends are corrective movements which may last from 3 weeks to 3 months. The primary trend may be interrupted by the intermediate trend. The short term trend refers to the day-to-day price movements. It refers to the oscillations or fluctuations. These three types of trends can be compared to tide waves and ripples in the sea. As we already know, Dow theory is based on three types of trends, that is primary trend which lasts for 1 year to 2 years, secondary trend which lasts for 3 weeks to 3 months, and minor trend it lasts for a period of 1 day. Primary trend. The security price trend may be either increasing or decreasing. When the market exhibits an increasing trend, it is referred to a bull market. The bull market shows three clear-cut peaks. Each peak is higher than the previous one. The bottoms are also higher than the previous bottoms. The revival period encourages more investors to buy scripts as their expectations about the future prices are high. In the second phase, increased corporate profits result in a further price rise. In the third phase, prices advance due to inflation and speculation. The reverse is true with the bear market. Here, the first phase of fall starts with the abandonment of hope. the chances of price moving back to the previous high level appear to be low. This results in sale of shares. In the second phase, companies report lower profits and dividends. This leads to selling pressure. The final phase is characterized by distress sale of shares. These two graphs shows primary trends. There are two phases of the market. They are bull phase and bear phase. Under bull phase, market shows upward trend. That means the prices will be going up. In the first graph shows bull market primary trend. Here T indicates the peak and B indicates the bottoms. There are three phases, that is revival period where investor expectation increases, which induces them to buy more. In the second phase, that is good corporate earning phase, it increases the earnings of the company, leading to further increase in the prices of securities. Third phase leads to more speculation. In the bear market, the security prices show falling trend. The second graph shows the bear market primary trend. There are three phases. Loss of hope. Investors lose their hopes on the scrip, so they start to sell the security. In the second phase, that is recession, it leads to low profits and low dividends, which increases the selling pressure. Last phase is distress selling, where there will be higher sale because there is no more hope for the investors. These are all about primary trend. Secondary trend. The secondary or intermediate trend moves against the main trend and leads to correction. In a bull market, the secondary trend can result in the fall about 33 to 66% of the earlier rise. In a bear market, the secondary trend carries a price upward and corrects the main trend. The correction would be 33 to 66% of the earlier fall. The intermediate trend corrects the overbought and oversold positions. It provides breathing space to the market. Compared to the time taken for the primary trend, secondary trend is swift and quicker. Here, the adverse movement of the primary trend lines is considered as secondary trend. This graph represents the secondary trend. In bull market, security prices are going up, therefore decrease in the trend for a short while is considered as secondary trend. In bear market, security prices are falling down, therefore short term upward movement of security prices is considered as secondary trend. These are just correction to the primary trend, which gives a breathing space to the market. Minor trends. Minor trends or territory movements are the random wriggles that occur in price movements. They are simply the daily fluctuations. Minor trends try to correct the secondary trend movements. It is better for investor to concentrate on primary or secondary trend rather than on the minor trends. The chartists plot the scrip price or the market index each day to trace the primary and secondary trends. Here, just like secondary trend, which are considered as the corrections to the primary trend, minor trends are the corrections to the secondary trend. They are the daily fluctuations. Here, by studying these kinds of trends, an investor can predict the future prices of a security, with the help of which he can take decision whether to invest in that security or not. This is the reason why Dow theory is being prepared. This is all about Dow theory and technical analysis. Thank you.